Well, joining us now, Gluskin, Sheff Chief Economist and Strategist David Rosenberg, and Samana, Global Strategist at Wells Fargo Investment Institute. Gentlemen, thank you for joining us today.
Thank you.
Thank you.
So, Samir, I want to start with you. One of the things that you mentioned in some of your notes this morning is that the stock market isn't attributing a high probability to an all-out trade war. Certainly when you see comments from the likes of RH this morning saying that they can basically shift in terms of the impacts of tariffs on some of their imports on furniture from China, it would seem that companies are more nimble than maybe perhaps had been originally anticipated.
Exactly, Morgan. I mean, the 2 points we would make is the risks are rising, but they're still very low. We only put a 20% probability on an unfavorable scenario where the sides can't get together and work out some kind of deal over the next medium term here. And then two, corporations have really gotten used to dealing with a lot of curveballs. And again, in the short term, they may have a tough time, especially some of the industrials, manufacturers who have maybe longer lead times. But some of the other businesses will be, as you mentioned, a lot more nimble.
And David, going back to the news that Steve Wiesman gave us at the beginning of this hour, the Fed further rate hikes consistent with expansion. One of the things that you pull out in your notes is the fact that the Fed is continuing to tighten, and that liquidity may be the biggest story this year for the markets in a year that has been very busy with news.
Right, and everybody's wondering why it is, notwithstanding how well the market's doing the past couple of months. The peak looks to have been put in January, which was really the month where quantitative tightening really took a giant leap forward. And that's going to accelerate between now and the end of the year into next year. And everybody talks about, rate hikes and the flattening of the yield curve. Few people are talking about what the lagged impact is going to be from the Fed shrinking its balance sheet. What I've been saying is that if the Fed does what it says it's going to do, the cumulative impact in terms of interest rate equivalent between the balance sheet and the overnight rate will be 525 basis points of tightening by next year. And there's actually never been a recession ever when we've had that degree of monetary tightening. Something to keep in the back of your mind.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.